what group are you in for M&A? Oh, you got that one.
Yeah, I'm going home that weekend on Thursday. So it was like going on the way.
What do they go on different days?
That's where I put that one.
Oh no, I know what you mean.
I was talking about it in the class I have like later.
Nothing else you'd rather do than do tax work.
He's Jared.
Yeah.
I just don't care that much, but
Now, make sure you sign in.
It's not for the politics, it's like I want to get it over with.
Double points. Okay, we're going to continue through with kind of our outbound planning. So U.S.-based taxpayers investing abroad. And we're kind of going through the timeline of kind of, educating yourself on the foreign market if you're targeting for investment. And so now we're all the way up to the point of, yes, we're going to do this investment, so now I'm going to form a foreign corporation. And I did just update the slides 20 minutes ago, sorry. I had a list in there that isn't correct from yesterday, so I'm going to do that today. So forming a foreign subsidiary, and again, we're going through U.S. tax applications and foreign tax applications. So a foreign subsidiary corporation is formed under the laws of a foreign country. It's a separate legal entity from its owner for U.S. and foreign tax purposes. Right? So it's the same thing as forming a domestic corporation in the United States, but you just have to do it under foreign law. And every corporation that I'm aware of in the world is a separate taxpayer. Right? And by virtue of doing that in a foreign country, you create a taxable presence kind of per se. There's no ifs, ands, or buts. We don't look at what the entity is doing or any of those things. That entity is a taxpayer by being formed under foreign country law. And so that requires the filing of a foreign tax return, reporting your results in there. So you have to maintain separate books and records in that. Future dividends from the foreign corporation may attract foreign withholding tax depending on that country's laws and the presence of the tax treaties. Corporations are depicted as rectangles or boxes or squares in organizational charts. When you see that, that means corporation U.S. If it's under U.S. law, foreign corporation if it's under foreign law. So what I want you to be taking away from this, and when we roll into more of the planning ideas in a moment, is start to tie concepts together from international tax and what we talked about this half semester. But if I have a foreign country corporation, foreign subsidiary corporation under foreign law, it's going to pay foreign tax, right? So the two things, I'm going to pay foreign tax on my activities, and how do I get the earnings out of there, right? I might have to encounter withholding tax, which may or may not be applicable, depending on that country's laws, and do they have a tax treaty with the United States that might lower that rate of withholding tax. Okay, so what does the U.S. think of a foreign subsidiary corporation? The profits may also be subject to current U.S. tax under our anti-deferral regimes that we studied in half A, right? That was subpart F. So if that foreign subsidiary corporation is doing certain transactions or has certain income flows, then that may implicate the long-standing subpart F rules. And we do get FTCs on that because we're going to pay foreign tax on any profits that's in the foreign corporation. But if that income stream gets taxed in the United States as well, we get subject to a foreign tax credit. We know we have the GILTI regime that then steps in after we've applied the subpart F rules. That's a limited period of time from 18 to 25. And then the One Big Beautiful Bill Act tweaked that to the net CFC taxable income, tested income, beginning in 2026, and we get FTCs allowed on that. That is the big catch-all, right? GILTI collected a lot of the remaining income and taxed it. Even more of it will be taxed under in CTI, right? If we have anything left over, that gets 100% dividends received deduction, and obviously no FTC allowed if we're not taxing the dividend from the foreign subsidiary in the United States when and if distributed, then we're not going to give any foreign tax credit associated with it. Now, if you think about what's going to fall into that third bucket, That is, remember guilty from half A, is only our intangible income. So it was our routine profits, kind of our routine earnings, 10% of our tangible assets. We didn't currently tax under the GILTI regime. So that could still be sitting there for many corporations, because they just haven't distributed it yet. If and when we have a future distribution, if you dip into those earnings, you will get 100% dividend. Okay? So that's the analysis that you would go through there. But so we have foreign tax on the income side, we have withholding tax on the distribution, and then we got to run through our anti-trust regimes on the U.S. side to see what the U.S. thinks of those foreign. Okay? So I want to compare a foreign branch and a foreign subsidiary corporation. That oftentimes comes up. In either instance, you're probably going to be subject to foreign tax, right? Remember when we left last class, a foreign branch is an activity done in the country, an extension of the U.S. Owner. That's likely going to be enough to trigger tax as well, just like forming a foreign corporation. So if you're weighing the two, there are going to be tax differences between the two, and there are going to be non-tax differences between the two. So the tax advantages of a foreign branch are the U.S. owner may be able to currently deduct the losses of the foreign branch against U.S. income. So if I have a branch operation, right, it's not a separate taxpayer. Its results automatically are included in its U.S. owner. Not all foreign operations are profitable, obviously. If I anticipate losses, I might be able to deduct those losses against my U.S. taxable income because they flow through the tax return on the U.S. If instead I started that same operation that had losses, but I started it in a foreign subsidiary corporation, losses don't flow up from a corporation, just like income doesn't flow up. It's a separate taxpayer, right? So many times I've had taxpayers who say, oh, I'm going to start an operation in a foreign country, but I'm not going to be profitable there for 3 or 4 or 5 years because it's just I'm getting started. I don't have the volume of business that I need yet to turn a profit. You might want to think about, do I start that in branch form? Because then the U.S. will subsidize that loss by giving you a deduction of 21% of the losses against your U.S. tax liability. So it's not a complete free lunch, if you will, because if you do turn the corner and become profitable, the U.S. will make you pay tax on the profits that come from the branch as well. Okay. Second item, the transfer of assets to a foreign branch. So if I'm doing the foreign investment, I typically got to get investments in there to start the business. So transfers to a foreign branch can be accomplished in a non-taxable manner. Very simple, because it's not a separate taxpayer. Like you've heard me say, right pocket, left pocket. It's basically that. You're going to have a taxable transfer from the owner to its branch. Now, the same can be said for a foreign subsidiary corporation. I can get assets contributed in there on a non-taxable basis. There's just some more requirements on that. If you're in business entities, today we're going to be talking about 351. This would be a 351 transaction. There's 3 requirements. I don't have the same requirements in a branch. If I'm worried about meeting certain requirements, I can do that easier in a branch form. So that might be important, might not be, depending on your factor profile. Okay, so let's talk about distributions from the business. So from a foreign branch to its U.S. owner are typically non-taxable. Again, not a separate taxpayer. Right pocket, left pocket. Including the absence of withholding tax. So usually you don't have a withholding tax in a foreign country because it's not a separate taxpayer that you might have if it was a subsidiary corporation. Now, apart from the foreign currency gain or loss that we learned about a week or so ago in section 987, right? If I have a foreign branch, I'm doing business in other than US dollars in that country, I have a 987 economic gain or loss that is taxable when I make a remittance of those foreign currencies back to the US, because I have a difference between the exchange rate when I included the income and when I distributed the currency. I either win or lose, and tax rules tax affect that income or loss under 987. US individual owners, so I think a lot about cross-border investment being from a corporation, but it can be a U.S. individual as well to make these investments. So I'm allowed a foreign tax credit if I do business in a foreign country in branch form. The income's gonna flow through to my tax return, but I can claim a foreign tax credit. If the individual instead did the same operation in a foreign corporation, the way the law is written, you just do not get foreign tax credits on a dividend that comes from a foreign corporation that you can as a corporation owner. So if you're dealing with a particular situation where your investor happens to be an individual, you might want to think a little more, put a little more thought into whether you want branch form or corporate form. The tax advantages of a foreign subsidiary corporation include at 100% dividends received deduction from the GILTI regime, the routine earnings in the GILTI regime, are available to a U.S. corporate owner, not an individual owner. So if I'm a corporate investor, I might want to have that access to those foreign earnings if I could get to 100% dividends received deduction. I wouldn't have that availability if I was an individual. Operating via a foreign subsidiary corporation may provide some control over the timing of income recognition for U.S. tax purposes. Right? Foreign branch income flows up on an annual basis. There's nothing you can do about it. You have no timing control whatsoever. If it's a corporation, you might have some level of control over when that income comes up because it might have to account for a dividend being declared and paid by the foreign subsidiary. Now, the reason I put may in that statement is because we have subpart F, we have the GILTI regime, now we have the much broader net CFC tested income regime, which are going to be very broad. They're included anyway. So I think in practicality, most of your foreign profits are going to be taxed currently anyway. So I see a lot of parity prospectively between operating in branch form and foreign subsidiary, corporate subsidiary form. But there might be some subtle differences there. Foreign tax incentives, we're going to talk a little bit about planning in a moment. But I'd like to pay the least amount of foreign tax possible. Just like a U.S. company would like to pay the least amount of U.S. taxes legally due, I'd like to pay the least amount of foreign tax legally due. Sometimes countries enact incentives, meaning that they will give me a lower tax rate or some other benefit if I make the investment in their foreign country. Obviously, what they're doing is they're competing with other countries for that inbound investment. It's no different than what you hear about here in the States. Companies building a new factory or something, they play all the states and the localities and cities against each other. Who's going to give me the best deal? Who's going to mitigate my tax burden? Same thing happens abroad. And that's just trying to attract investment, just like states are trying to attract investment. Why? Because of jobs, right? Investment means you hire people. So countries are interested in that as well. Sometimes the foreign tax incentives are only available if you're doing business in the country in corporate form. So that may not be the best tax answer for you, but it gets you the best, or may not be the best U.S. tax answer for you, but it allows you to get the answer that you want from a foreign perspective and avail of those benefits. So you got to be on the lookout for that. The separate legal status of a foreign subsidiary may make it easier to justify management fees and other intercompany charges to foreign tax authorities. So many times, if we have a foreign subsidiary and we're charging fees for services provided by the U.S. Operation, that can be management fees, that can be other intercompany charges, IT charges, anything like that. It may be easier if the foreign country audits the foreign company's tax returns if they see it being a corporation. I've just seen this optically, it works pretty well. Whereas if it's in branch form, it's kind of weird because you don't really have separate financial statements. You have to create the financial statements for the branch operation. But then when they see a big intercompany charge there, they may ask, well, why are you paying an intercompany charge that should be deductible in my country if you're just operating in branch form? So many times if you anticipate those type of intercompany charges and you want a deduction for those in the foreign country, you might want to skew towards being a foreign corporation. The sale of shares. So I like to think about investments all the way through the time horizon. So from start, operation to you ultimately might exit that business, right? There's divestitures. Companies sell subsidiaries all the time. So if I were to exit this operation, divest of it, what's my foreign tax implications of doing so? If I do that business in a foreign corporation, I may be able to sell the stock of the foreign corporation, foreign subsidiary to a new buyer and not incur foreign tax on any gain on that. If I have a branch operation, I can sell the branch assets, right? Sell the trade or business assets of the branch, but that might attract foreign tax. I'm selling assets in the country versus stock where I might be able to say that's a non-taxable gain in the foreign country. So those are things that might skew you towards, from a tax perspective, to a foreign subsidiary corporation. Okay, let's do 8.1. This is Jihan. Jihan was here at 9:10 preparing for this exam.
Right. So in this example, we have a U.S. company earning 10 million in foreign source income, and then if we assume a 21% U.S. tax rate and 15% foreign tax rate, would result in total foreign taxes of 1.5 million and 600,000 in residual U.S. tax after the foreign tax credit.
Yeah, so let me pause you there. So we got two pictures on the bottom. One's just saying I do the same operation in branch form or I do the same operation in corporate form. And so this goes to my point, your foreign tax is likely going to be the same, right? Because you're doing the same thing in the country. So the branch operation, yes, it's an extension of the foreign parent, but you're actually doing business. So you're liable to trip that, that threshold to become a foreign taxpayer. You're doing the same operation, so in theory, your profits should be the same, subject to the same corporate tax rate, right?
Yeah, and on the other hand, if U.S. code structures the foreign facility as a subsidiary, and in that case, anti-deferral regime does not apply, U.S. code will still, like you said, will still pay the 1.5 million in foreign taxes. But then when earnings of the foreign branch are distributed in dividends back to U.S. code, the DRD eliminates any additional U.S. tax, which is the extra $600,000 of residual U.S. tax. So that will save them $600,000.
Yes. So the distinction on the tax side is I have automatic tax on the branch operation in the United States, right? So foreign tax, and there's a typo here. This has got 2 million down here for some reason. That's 1.5. So I pay 1.5 of foreign tax and then I layer on U.S. tax. Why do I layer on U.S. tax? Because the foreign tax rate is 15. The U.S. rate is 21. So even though I can get a credit for the 15% tax, I have to pay up to 21. So that's the residual, incremental, however you want to refer to it, additional U.S. tax to get to a 21% rate. What they're posing here is if I instead, on the right side, I do the same business in foreign subsidiary form, and very importantly, this is assuming facts that I'm in 25, and the 10 million of foreign profit is not subject to GILTI or subpart F, meaning that it's going to be routine profits that I don't currently tax in the United States, then I won't have residual U.S. tax on those earnings. When I make a distribution in the future of those earnings, I'll get 100% dividends received deduction, no further U.S. tax. So it's just going to show you that in this instance, if I do the business in branch form, I'm going to layer on additional U.S. tax. Corporate form, I may not. Now, if you flip this on the head and you say, oh, what if the foreign branch was losing money? And that's where on the left-hand side it would be better because those losses would flow to the U.S. and be deductible at 21% on the U.S. tax return. On the right side, they'd be stuck in the foreign subsidiary, right? They don't flow up. The subpart F, the GILTI regime, the net CFC tested income regime, it's only currently taxing income, right? Not losses. There's no anti-deferral on losses. It's just deferral on losses, right? Okay. I think that's a key example to show you the difference between the branch and subsidiary. Okay. There are non-tax considerations, right? I've said many times, the best tax answer may not win as to the choice of the investment and how the form of the investment is made. So non-tax considerations in deciding between operating in foreign branch versus foreign subsidiary corporation form include, as you know, the foreign subsidiary corporation can provide limited liability protection to the owner. This example, USA Co. is fully, on the left, fully exposed to any liabilities created by the foreign branch operation. Meaning that there's unlimited liability. So if there's a bad accident at a factory and people lose their lives and there's litigation as a result of that, USA Co. can be liable for all of those damages, right? You contrast that to the right-hand side. If that same accident happened in a foreign subsidiary, the only legal liability that USA Co. has is its investment in the foreign subsidiary. It's not unlimited. Okay? Now, I think you have a practical aspect here. You have the legal limitation of liability. But my experience has also been that most US multinational companies don't walk away from their liabilities, that they would step up and make good on these liabilities. But at least they get the opportunity to make that decision. They don't on the left side. The left side, that's the non-tax. You might have got the best answer, the flow through of the losses is what you were trying to do, but then you invite that unlimited liability. And whether that's a big deal for your company or not, or your client or not, depends on the facts. What are they doing? Is it an industry in which people get sued and there's litigation and there's big problems sometimes? That may be towards doing business in. Okay, a foreign branch may be easier to operate from an administrative standpoint, right? If I form a foreign corporation, I have to hire an attorney. I probably have some state filing requirements. I may have some annual filing requirements. I may have some statutory audit filings that I have to do in the foreign country. That all costs money, right? I either have to pay somebody to do it, I have to hire people to do it. Not a bad thing, but I just have to do that. If I instead do the business and do the investment in branch form, I may have a slightly lesser burden from an administrative standpoint, cost and people. I'm still going to have some, but it might be slightly less. The optics of a foreign subsidiary corporation may be perceived better by foreign customers and employees. This is an interesting one. If I'm doing this picture left and right again, sometimes foreign employees, if you're trying to invite them to join your business, especially your leadership in that country, they may want to work for a corporation. It's just more highly respected in the foreign country in some instances to work for a corporation. And so that may be something that's very important depending on how desirable this potential employee is to your operation. And so you might have to listen to that, even though it might not be the best tax answer. Okay? And customers as well. Many times a customer prefers to deal with the corporation that, oh, you're a US company and you got a branch operation here, so who am I dealing with? And that type of thing. So sometimes the contractual relationships with customers is made easier in a foreign corporation. Now I put optics on there because there's nothing legally requiring any of that, right? That's just you're negotiating with a person. And a person might say, I prefer to do this, and whether they contract with you or work for you or not, depends a lot on those optics. A foreign subsidiary corporation may have some minimal capital requirements that may not be applicable to a foreign branch. So just how much money do you have to put in the operation? Some countries require a certain amount of capital to be put in, depending on what type of business you're doing. That may or may not be a problem for you, and if it is, you might want to think about comparing it to a branch operation. Okay, so there we went through export sales, we went through licensing, we went through branch form, we went all the way through to subsidiary form, and I kind of think that is kind of the evolution, right? If you're setting up a foreign subsidiary corporation, there's not a step beyond that, right? You have reached the end. Now it's just growing your business. So now I want to introduce to you, this is prevalent in the domestic context in the United States, but it's very prevalent in international investments, and it's called hybrid entities. So If you took my tax and business strategy course, we covered a little bit of hybrid entities in that course as well. But the definition of hybrid means it's kind of parts of two different things. Okay? So in the past, in the very recent past, we've just been talking about something's a branch form or something's a corporation form. And it's that for all purposes of any stakeholder that's looking at it. So if it's the US, they view it the same as the foreign country. If legal looks at it, they view it the same as the US tax people who look at it. If insurance people look at it, they view it the same as the US tax people view it. So there is no hybrid about it. It is the same form of business for all purposes. Accounting, view it the same. So here we're talking about we're going to have some discrepancy, some differences between the way the US tax rules view the entity and everyone else in the world. Okay? And that's because for certain entities we're allowed to elect our US tax classification. Okay? And that can mean that I can choose a tax classification that is inconsistent with the way the rest of the world would view that legal entity. And these are the check the box regulations is what they're called, check the box rules. They've been around for many years, 35 years I think now. So corporate America is very adept at using these. So you're going to see these kind of symbols in org charts. And I want to kind of introduce them to you here and show you a way as you're learning around these entities as the way to approach these entities, kind of understand what's going on with them. So a hybrid entity is first an eligible entity, so we'll talk about what that means in a moment, that a foreign country considers a corporation, but the U.S. treats as either a disregarded entity in the case of a single owner, or a partnership in the case of multiple owners for U.S. tax purposes pursuant to an election. So this election that we are filing is with the U.S. tax authorities. So by definition, it only has effect for U.S. tax purposes. The legal people do not care. The accounting people do not care. Treasury does not care. The foreign country typically does not care. U.S. taxes will only affect making this election. So certain types of foreign entities, what we call per se entities, are not eligible to elect to change their U.S. tax classification other than that from a corporation. So the U.S. regulations have a laundry list of countries and who these per se entities are that you cannot treat other than as a corporation. I like to think of that list as the top of the food chain. They are the highest level of corporate form in that country in which you're doing business. So, for instance, in Germany, that's an AG. That's the abbreviation of two words that are in German that I could not pronounce. They're very long, but the abbreviation is AG. BMW is an AG. Okay. I think of another German company. I don't know if BSF is a German company, but the AG. So it's their highest level of corporate form, publicly traded, large organization. In UK, it's a PLC. A PLC is a public limited company. It's the highest level of corporation in the UK. So those entities, if that's your foreign investment and you choose to form an AG, you will not be able to make a U.S. tax classification for that. It will have to be treated as a corporation. Below those levels, there's lots of different types of entities that allow you to get corporate treatment that we can then change our classification other than as a corporation for U.S. tax purposes. For example, in Germany, there's an entity called a GmbH. 4 words. GmbH is the first letter of each one of those, but it's equivalent to a U.S. LLC. It's got limited liability, but it's not the highest in the food chain, if you will, of corporate forms of doing business. So that's the entities that U.S. multinationals use in these types of planning. In the UK, the example, I had the PLCs, the private, public limited companies. I also have private limited companies, which is their LLC equivalent. So these are the entities that you'll be seeing people are using hybrids in their So hybrid entities provide U.S. tax advantages of a flow-through entity while still providing the U.S. owner with limited liability under foreign law. So I like to think of these things is you have to look at the symbols on the organizational chart, put your U.S. hat on, and say what is going on in this entity and the transactions in which it's involved in, and then take that hat off and put your non-U.S. tax hat on. What does the rest of the world stakeholders think that this entity is and what its role is in the transactions it's doing? So, the disregarded entity. This is also called a DE in parlance. So a disregarded entity, and I put down here the little cheat sheet so you can start getting used to what these things mean, is a corporation for legal liability purposes and non-U.S. tax purposes. That means we look at the box around the entity for everything but U.S. tax. Corporation for legal liability purposes and non-U.S. tax, which means accounting, insurance, legal, foreign tax. Everybody thinks it's a corporation. For U.S. tax purposes, we've made an election which we would depict on our organizational charts as a circle inside the box. Which means when we take off our non-U.S. tax hat, put our U.S. tax hat on, we see the circle only. It's a branch. What does that mean? That means it's not separate as a legal entity apart from its owner. Just like what we talked about with branch forms. So we call it a disregarded entity in the parlance of the regulations because it's disregarded as an entity separate from its owner. So it's hybrid. You can see we got certain stakeholders who say, oh, there's a corporation. U.S. tax, we say, no, not a corporation, a branch. Okay? That can open itself up to some very, very interesting tax results from a U.S. tax perspective compared to the rest of the world. Okay? So if you go and you talk to legal or you talk to accounting, you say, oh, I'm looking at that UK disregarded entity, they will look at you like you got two heads. Like, what are you talking about? That's a US, or that's a UK private limited company, corporation. Same with the lawyers, it's corporation. But you filed a US tax election, effectively changing its classification from that of a corporation to a branch, i.e. disregarded entity separate from its owner. Similar to that, we have what is called a hybrid partnership. So, again, we have the box around the triangle. The box is a corporation for legal liability and non-U.S. tax purposes. So these are the same. Everybody else dealing with this entity thinks it's a corporation. We have filed a classification election to treat it as a partnership for U.S. tax purposes. The only distinction between these two owners is this entity has a single owner. This entity has multiple owners. I have multiple owners of a flow-through entity. It's a branch for U.S. tax purposes. Okay. So I'm treating this as a partnership for U.S. tax purposes. Those of you that are in business entities, we're going to cover in a couple weeks. We're going to start covering partnerships. So all those partnership rules would come to bear on the right. They would not come to bear on the left. That's solely for U.S. tax purposes. Again, the rest of the world, you go down the hall and you talk to legal, hey, I'm working on this UK partnership. They'll be like, I don't have a UK partnership. It's only fictionally there from a U.S. tax perspective because of this election. So you have to just get comfortable being, that's why I think throw the two hats on. Who are you talking to? How are they approaching it? And then when you're doing a U.S. tax analysis, all of that stuff doesn't mean anything. What is the U.S. tax classification of the entity? Okay? And so hybrid entities are either boxes with circles or boxes with a triangle. Okay, then we have this crazy guy, the reverse hybrid entity. So we have hybrid entities and we have a reverse hybrid entity. So the reverse hybrid entity is the same box, so it's a corporation for non-U.S. tax purposes, just like this guy on the right here. But you see the triangle is upside down. And he we'll call this an envelope. You ever use, I don't know if you guys ever use snail mail anymore, US mail, but there's such things as envelopes. The envelope here depicts that it's a partnership for, sorry, I misspoke here earlier. So it's a partnership for legal liability and non-US tax purposes. So the rest of the stakeholders besides US tax purposes think this thing is a partnership. We have come in and thought about and decided to make an election to treat this as a corporation for US tax purposes. So it's just the opposite of what this conversation is here. When you go and talk to everybody else in the organization, they think this is a partnership. But you know, when you go to do your tax analysis in the United States, it's a corporation. And there's lots of reasons why you might make these elections. It's a very controversial topic around the rest of the world because this regime does not exist in the rest of the world. It's the only place. And when this stuff first came out, it was so fascinating having conversations with non-US tax professionals because they were like, what are you doing? No, that's not what that is. And so it's just an ability to look at one legal entity and treat it differently on different stakeholders. Okay. Again, reverse hybrids are foreign entities that the foreign country considers a partnership and the U.S. treats as a corporation for U.S. tax purposes. They provide the advantages afforded a foreign subsidiary. So we, United States, treat that as a foreign corporation. So the 100% dividends received deduction is available for routine foreign profits, and it gets flow-through treatment under foreign law. Why? It's a partnership. Partnerships, in nearly every country, partnerships do not pay tax. The partners pay the tax on the partnership income that flows through to them. That would happen on this entity. But we see it as a corporation, so its income does not flow anywhere. Corporation rules, in our mind, profits do not flow out of a corporation until and if declared as a dividend and paid by the corporation. So let's do this example. K3 is Sydney.
Year 1, USA Co. organizes a foreign partnership in country L. USA Co. makes a check-the-box election to treat FP as a corporation for U.S. tax purposes. FP's earnings are not subject to country L corporate income tax because of its partnership status.
Right, and that's just the general rule. It's treated as a partnership under foreign law. So FP itself, that legal entity that makes money, does not pay tax because partnerships do not pay tax. Partners pick up the tax. So you have a distinction at this level as to who the foreign country thinks is the taxpayer. They think USA Co. is the taxpayer because it's the partner in the partnership. Right? And Sydney's going to tell us US treats it different. Okay?
In addition, because of FP's treatment as a corporation for U.S. tax purposes, FP's earnings do not incur U.S. tax. If FP distributes all of its earnings to USA Co. in year 5, the dividend would be exempt from U.S. tax pursuant to the dividends received deduction.
And that's because we've made an election for this operation to be treated as a corporation. So everything we've talked about from corporate form bear on this when we're looking at it from a U.S. tax perspective. But it only has effect for U.S. tax perspective because I've only filed this election with the U.S. tax authorities, and they're the only ones who respect this as something other than a partnership. So you can see the dichotomy here, and this is where I want you to think about taking your hat on and off. If I put my U.S. hat on here, FP is a corporation. Everything we just talked about with corporations bear, right? Does it? I'm not currently taxing its earnings, subject to subpart F, guilty, net CSE tested income, possibly getting 100% dividends received deduction for my routine earnings under the guilty regime. I take that hat off and I put my hat on for foreign tax purposes, and I see partnership. It doesn't pay tax. The partners pay the tax, so USA Co. needs to pay tax in the foreign country. If I'm dealing with legal, they're going to say, oh, that's a partnership. If I'm dealing with accounting, they're going to say, oh, that's a partnership. All the profits are at the partner level. Okay, so there could be various interesting planning ideas that people do by using this hybrid nature of these types of investments. But you have to get used to, it only has effect for U.S. tax, and the rest of the world doesn't treat it that way. Okay, so how do I make this election? So I elect this by filing Form 8832. It's a U.S. entity classification election. I have to be an eligible entity, right? Meaning I can't be one of those per se, top of the food chain, foreign corporation entities, but anything other than that is an eligible entity. And I don't have to make this election. It's an election I can think about and make at the beginning of my foreign investment or in the middle of my foreign investment. So practitioners commonly refer to the entity classification election as the check the box regime, as the election is simply made by checking the desired box on Form 8832, which we'll show in a moment. 8832 can be filed with an effective date up to 75 days prior to the date you file the return, file the form with the U.S. government. So it has a retroactive feature to it. So if I form an entity today, and it's eligible, so it's not top of the food chain corporation, GmbH, I have 75 days to where I can file that election and make it effective to the day today. I have a retroactive aspect to that. Entity's tax classification can be changed from its initial tax classification. So I can choose to be a corporation, I can choose to be a partnership at the beginning, and then I can change that subsequently. But once I change, I can't change again for 5 years. So the U.S. government doesn't want me to just flip, and do this stuff all the time. So I get one free, people like to say this, I get one free change of mind. So if I start at something, I can elect to change it, but then I have to wait 5 years to change the second. Okay, so here's the form. This is the Form 8832 entity classification election. It's not very long. This is the top part of the form. You meet relatively straightforward regulatory criteria. You simply elect their desired tax classification for certain foreign entities, partnerships, and LLCs by filing Form 8832. So the reason it's called the check the box regime is you see these boxes over there. So 6A is a domestic eligible entity electing to be classified as an association taxable as a corporation. That as an association, I've always disliked that language, but you're electing to be taxed as a corporation. So that's what you could do if you form an LLC under U.S. domestic law and you want it to be treated as a corporation. You would check 6A in filing this. If not, your LLC, if it's got a single owner, would become a disregarded entity of you, i.e. a branch. If it had more than one owner of the LLC, it would become a partnership, absent filing this election. Okay? So the first three are for domestic eligible entities, corporate form, partnership form, disregarded as a separate entity. And then 6D, E, and F are the same thing on the foreign side. So I have a foreign eligible entity electing to be corporation, partnership, or separate entity. So all I have to do is form my entity if it's eligible, and I evaluate letting it become its default classification. If I want to change from that for some reason, some planning that I might be doing, then I simply file this form, check the box, and voila. For U.S. tax purposes, it is one of these things. It only has effect for U.S. tax purposes. That's the only stakeholder that's allowing me to make this election. Everybody else thinks it's what its legal form is. So, I do have a default classification, which I mentioned. If the taxpayer does not make an affirmative election to change the classification. So when I form a legal entity, if I choose not to change it, not file that form, it won't. The U.S. has to classify the entity as something. And so, if it has more than one owner, and at least one of them has unlimited liability, legal liability, the foreign entity will default to be that of a partnership for U.S. tax. That's what we think of a partnership. I form an entity, and at least one owner has unlimited legal liability, that looks like a partnership. So absent going in and changing that default classification, you'll be treated as a partnership for U.S. tax. If all of the foreign owners have limited liability, the foreign entity will have a default classification that of a corporation. That's what we think corporation is, right? Corporate owners have limited liability. All of them do. Okay? So if that's the entity that we're thinking about, we form that entity. It will default to be a corporation until I change that by filing this form, if I want to. Okay? If the foreign eligible entity has a single owner, and that owner has unlimited liability, so I only have one owner, so this is the difference between 1 and 3, multiple owners in 1, single owner in 3, then that owner has unlimited liability, that will default classification to a disregarded entity separate from its owner, similar to a branch. That's this example that we went through earlier. Oh, sorry. This example. This is the disregarded entity. I have a single owner, and it will default to disregarded entity form absent filing of an election treated otherwise. So this is something you would look at as to what's the purpose of this entity, what are the transactions it's doing, do I want to change that classification and get a different result for U.S. tax purposes? That's where I might entertain a hybrid entity. The reason I bring this up for you is not to be an expert in hybrid entities. If you look at org charts for large organizations, you're going to see all these symbols all over the place. You're going to see some of these things in there. That's going to be just historically they've made these elections for these entities. And I want you to get comfortable saying, oh, I know what that is. I remember we looked at that. The envelope is a reverse hybrid. And think back through what that means. That means it's a partnership locally, corporation, solely for U.S. tax. Okay. So let's shift gears to outbound tax planning. So again, U.S. multinational, we have decided our investment. We have multiple investments going on around the world. What is top of mind for that U.S. company in trying to manage their global tax liability? So this involves, I like to think of this as a balance. You're trying to balance the interplay of the laws of two or more countries in assessing the overall tax efficiency of a particular transaction or income flow. Okay, this is why I think you see the big four accounting firms kind of play in this area much more than next tier of firms and law firms, because they have the global breadth. They're in all these different countries, all these major cities, and you have to understand if you're doing a transaction from the United States into India, you got to understand the Indian side of the transaction. And I can't do that sitting in the United States typing stuff into ChatGPT. I need to talk to and work with an Indian colleague that understands what the client's trying to do in that country, what my client's trying to do from this country, and let's get to the best overall tax efficient answer that allows them to do their business transaction. So our goal is to reduce the U.S. and foreign tax burden on the U.S. parent company's foreign source income to the least amount legally due, right? We've never talked about anything where we're trying to skirt the law or do something that's illegal, but we're trying to pay the minimum that's required by the law while accomplishing the non-tax objectives of the company, right? So that goes to, we might have the perfect tax plan to do this investment into India, but what the company wants to do kind of doesn't fit with that tax plan. Well, that means our tax plan's got to change, right? It's not the lowest cost tax alternative that wins. We have to accomplish what the business people want to do in the least costly manner, including tax. Right? That's the winning idea for the company. Okay, so here's just a laundry list of things that when I was helping outbound companies think about, these are the projects that we would work on to try to do that, try to get the least costly alternative that would accomplish the business objectives. So we're going to go through each one of these and give a little color to these. So First, we might be operating in low tax foreign countries, right? We know the US tax rate is 21%. I could have the option to work in invest in higher tax countries, because there are countries that 21%, if I haven't told you already, is roughly in the middle of the median, if you will, of the tax rates around the world. We have about half higher and about half lower. And there's a bunch of them right in the low 20s. So the United States, when we went from 35 to 21, didn't feel like we needed to be the lowest. We just need to be competitive. So we landed in the middle and chose 21%. But our investments, if we can do business in a lower tax country, that's going to lower our overall tax burden. Now, certainly U.S. companies have investments in France, in Germany, India, I'll list as well. Those are traditional higher tax countries, and that's an example of where the business objectives are going to outweigh the tax objectives. Because if you're operating in Germany, I'm going to tell you, well, you're going to be paying tax at 30% plus, and the United States is a 21% jurisdiction, so remember back to our foreign tax credit planning, you're going to be in an excess credit position. You're going to have paid more foreign tax than we can credit in the United States, because our limitation is 21%. Now, if you pay tax instead, and you do that same investment that you were going to think about doing in Germany, and you do that in Ireland, you're going to pay tax at 12.5%. Now, the U.S. rules, foreign tax credit, are going to bump that from 12.5 to 21, but no higher than 21. So when I say operating in a lower tax jurisdiction, I'm thinking of 21% or lower, right? Now, every country's different customers, different raw materials, different workforce, all kinds of different profiles that would cause a company to be interested in one particular jurisdiction over another. But all other things being equal, if you do the same investment and get the same return, you'd like to aim for a jurisdiction that's 21% or below. Aiming something higher is going to increase your tax burden relative to 21%. Okay? So remember, and I'm looking at this from a prospective standpoint, right? Because if you're planning, anything we can do about 25. 25 facts have already happened. So the only planning we can do is from April 1st, April Fool's Day, forward, right? So we're in the net CFC tested income regime from the One Big Beautiful Bill. So beginning in 26, the U.S. taxes non-subpart of earnings of a foreign subsidiary less heavily. We only tax that up to 14%, right? So remember back to our anti-deferral regimes. Yes, we include the income currently in the United States, but we don't tax it all the way to 21. We tax it less heavily. We tax it up to 14%. So I might need to clarify what I said earlier about my hypothetical of investing in Ireland. I would take that 12.5% and bump it up to 14%. Still less than 7% less than the U.S. tax rate. Right? So that's appealing. That's why Ireland is always in the conversation of investment into Western Europe. It's because it's got that low tax rate, educated workforce, largely English speaking, and like a portal into the EU, right? It's a member of the EU. The UK is no longer a member of the EU. So if EU directives are something of interest to you and the free movement of goods within the EU, Ireland has a great deal of appeal. And don't underestimate that it's a direct flight from the East Coast to Dublin. So it's very easy for people from New York and Boston to get to back and forth. They can day trip to Dublin. Okay, so again, operating in a low tax, pay the least amount of foreign tax, and the U.S. doesn't tax it as heavily as U.S. activities. That's something you might want to think about right off the bat. So a U.S. multinational may be able to reduce its worldwide tax burden by moving or shifting non-subpart F earnings, assets, and activities to a foreign subsidiary in a less than 21% jurisdiction. Right? This is what companies think about when they're evaluating where do I make my next investment. Right? If I have a need to expand my manufacturing footprint, am I going to do that in the United States? Am I going to do that in another country? I'm going to have to think about logistics of moving the product and my employee base and everything. But is that something I would be willing to do? And tax rates are going to be a factor that's going to be considered. So I do need to think about any foreign withholding tax. So not just, am I going to invest in Ireland because I like that 12.5% rate, but think it all the way through. Well, I'm going to make money in Ireland. Aren't I going to want to make a distribution back to the United States? What's the withholding tax coming out of Ireland? Because that's going to work in the other direction. If I add on withholding tax, that's going to make that 12.5% look a little higher, right? To get my hands on the money. So I'm pretty optimistic that the U.S.-Irish treaty is a 0% withholding tax rate as well. So that's going to be appealing. But think through the entire lifeline of the investment, not just day one. What's my tax rate? What's my fully repatriated earnings tax rate? So operating in a foreign tax country is going to be the first way to lower your tax liability. Now, the ability to move or shift earnings and assets from the United States to a foreign subsidiary is constrained by the following, right? Transfer pricing. I cannot just start moving profit out of the United States through another country by adjusting my transfer prices, right? My transfer prices are the prices I pay intercompany. So if I'm doing transactional flows through my Irish subsidiary, somebody might say, well, let's charge Ireland less on our sale to Ireland, so when they sell it to the customer, they capture more profit. Well, transfer pricing, as you probably heard me say, is the regime that prices intercompany transactions as I would a third party. So I think of it as a guardrail. I won't be able to artificially push profit in there by selling them product at a low price so they can on-sell it at a higher price. My sale to Ireland has to be equivalent to a third-party sale. So transfer pricing is going to frustrate you in just arbitrarily moving profits around the globe. What I have to do is move assets, responsibilities, new business, that type of thing has to be done in Ireland. Now, if I do that, I can capture more profit at that lower rate. And as you know, Subpart F will frustrate the ability to move profit offshore because if I do some of those transactions, I sell to Ireland on its way to Germany, that's two countries crossing two borders and a related party on one side, that profit will be immediately taxed in the United States and it's not taxed at 14%, taxed at 21%, right? Subpart F is taxed at 21%, so it's as if I did nothing. So I do have some handcuffs, guardrails, whatever analogy you want to say, but I can't just arbitrarily move profits into a low tax country. I really have to think about doing it. So the way I think about that is future investment. Like if I'm going to expand new manufacturing footprint, where do I put that? Or if I'm going to add a new line onto an existing facility, where do I put that? Maybe I put that in my Irish subsidiary. Okay. Contrast that, I operate in high-tax foreign countries. So if I operate in a high-tax foreign country, that risks pushing the U.S. company into an excess FTC position. Pay more foreign tax than they credit in the United States because the U.S. will only credit tax up to 21%. That's the purpose of the FTC limitation we learned about MAFA. If I'm in excess credit position, that pushes up my worldwide tax burden. That's not a bad thing. But if you're a tax advisor, you have to make sure management understands that. If we're looking at doing this investment in Ireland and we're comparing and modeling it against doing the investment in Germany, Germany may win for any number of reasons, but understand that our effective tax rate is probably going up. Don't come to me in a year from now and say, oh my gosh, why is the tax rate going up? Let me find that email that I sent to all of you that told you that I understand your reasoning, but the tax rate is going to go up. And that's what you need to tell the analyst community. Is don't just look at why my tax rate went up. These are the reasons I chose Germany. Those are the consumer base there because my lower transportation costs of getting the product there. That type of thing. Okay? So incurring foreign tax increases the U.S. company's worldwide tax burden only to the extent the foreign tax is not creditable against their US tax. That causes that excess FTC position. So if I'm in an excess FTC position, that usually leads me to two other ways of trying to deal with that. I try to foreign tax reduction and or increasing my FTC limit. So if I lose that as the tax party to the group working on this, I lose the investment decision and it's not in Ireland, it's in Germany. So I know we're gonna have this excess credit problem. I don't just stop. I try to deal with the facts at hand. And the way I would do that is, let's try to pay the least amount of German tax possible. And we're gonna walk through some ways that I might think about doing that. But to the extent I can get the German tax rate lower than that 30, that each dollar lower is less excess FTCs, which is less upward movement of my effective tax rate, right? So don't just slink away and say, okay, I'm sorry, you guys chose the high tax jurisdiction. Now try to make it as least costly as possible. The other thing I can do is try to boost income in that foreign tax credit limitation basket, right? Remember our calculation from half A. If I get that limitation higher, that provides more room to utilize credits. Utilizing credits means I pay less tax in the United States because I'm paying my US tax with credits, right? So those are knock-on effects of choosing to do business in a high tax country. So let's take those in order. Foreign tax reduction. So I can utilize techniques to reduce its foreign tax burden similar to techniques that reduce US tax on US income, which is realizing income in a form that is taxed preferentially. This is where I'd be working with my colleagues in my, I'll just think of my hypothetical, in Germany. It's like, what can we do to pay the least amount of tax on this investment? So, are there income forms that are taxed preferentially that maybe the business people can work within? Can I defer the recognition of income? Can I accelerate the recognition of deductions? Do you have accelerated depreciation in Germany? What if I'm building a facility there? I'm going to have all this CapEx in Germany. Can I lower my burden by accelerating my tax deductions in that country? Other tax reduction techniques are unique to the international context. So I could avail of local tax incentives. Ask the question, are there any incentives for this investment that I'm doing? Unfortunately, the answer you're going to find in most Western economies is there is none. Germany is not going to give you an incentive to build a factory in Germany. Instead, if you go to Malaysia with that same question, they're liable to give you a lower tax rate. Why? Because they're trying to attract more investment. Germany is of the view, vast generalization, that they have other things going for them. They don't have to give incentives to attract investment. Other parts of the globe are trying to incentivize investment. Singapore, classic example of giving lower tax rates and incentives to companies to make investments into Singapore. Okay? So, ask the question. You may not get some, but there may be some local tax incentives that you can get. Intercompany debt financing, so lending into the country and trying to lower the tax burden by inserting debt into the country to which an interest expense deduction is paid. Interest expense is usually deductible. So how am I going to finance this investment? Maybe I lose the argument between Ireland and Germany, but maybe I can convince the business people, well, let me finance some of the German investment by lending to Germany from the United States. Don't just put all equity in there, because remember, dividends are not deductible, interest is deductible. Okay. Transfer pricing. Are we going to have transaction flows? Remember, I've told you transfer pricing is the guardrails, but they're usually a range. So I can skew within the range, and most transfer pricing people will tell you that any point in the range is as good as any other. So if I have the ability, and I say I'm doing intercompany sales from the United States to Germany that go into the German market, I'd like to limit the amount of tax that I pay in Germany, so limit the profit in Germany. Maybe I want to sell for a higher price so that more of the system-wide profits taxed in the United States at 21 versus 30 plus in Germany. Maybe I take that cost plus and I do it, a lower plus still within my range, but just every little thing can help. So maybe I do that to help a little bit is just navigate within the guardrails of transfer pricing. And then make sure on any withholding tax flows, is there a treaty involved? And are we sure we're applying the lowest rate in the treaty? So if there's dividends coming back or royalties coming back or interest coming back from, say, Germany again, there is a treaty between the US and Germany. Am I making sure that you're applying the right withholding rate? Again, I like to think of these things, if you like baseball, we're starting baseball season, it's singles and doubles. There's not a home run. You're just trying to chip away at it, make a bad situation as good as it can be if you are finding yourself investing in high tax foreign countries. Okay, so just a little bit more color to that. So availing of local tax incentives. So think of these as special tax exemptions, sometimes called holidays, which means like, oh, we'll tax you less heavily for the next 5 years, 10 years from this investment. And that might be something that's very appealing. And again, that's completely legal because that's what that country is choosing to do. And I mentioned Singapore has historically offered tax incentive companies for certain advanced technology companies. They want to become a center in the Asia-Pacific region for that type of activity. Malaysia has offered tax incentives for companies to establish operations within its borders as well, trying to build up its manufacturing profile within the country. So many of these countries will negotiate with potential investors to lower the tax rate imposed on the operations in exchange for the investment. Intercompany debt financing. So this is, how do I get the money in the country? Right? So if I'm going to start in Germany and I'm going to build something in Germany, they need money. Instead of putting it all in as equity, the only return on equity is dividends. Dividends are never deductible in arriving at your local tax liability. If I go part equity, part debt, by lending some of the money from the US, then the deduction can come out of Germany as a deductible interest expense in part. Certainly taxable interest income in the United States, but I'm taking it from a 30% jurisdiction and taxing it at 21%. It's a net 9%. Good guy on your global tax plan. Now, every country has deductibility of interest rules. Interestingly, you guys all know, I think, many of you are in business entities, the deductibility of interest rules in the United States is 30% of EBITDA. That started in Germany. Decades ago, Germany started a 30% EBITDA rule. So when countries started looking at, oh, we need to limit our interest deductions, they said, well, let's just do the rule Germany did, 30% of EBITDA. So now the US is 30% of EBITDA. So you'll have rules like that that will likely limit the amount of interest expense. Because think of that country, they're willing to let some interest expense, which is a base erosion planning into their country, but they don't want to overdo it. So that's why there's these limits. Okay, so interest income received by the U.S. is currently taxable at 21, but you might be able to get a deduction at 30 plus. And it might be able to increase its foreign tax credit limitation. We have 4 baskets, and this probably be in the general basket by creating low tax foreign source income. So again, thinking through the lifeline of these things, and what basket are you going to place the income in, and what's the foreign tax credit profile in those baskets. Transfer pricing, I talked about the guardrails and just trying to not manipulate, to push income between jurisdictions within the range, seeing what that does to the overall tax liability. And so, like charging lower prices on inventory sales to a low tax foreign jurisdiction moves income from the United States to the foreign subsidiary corporation, right? Because they're going to unsell it and capture more of the system-wide profit there. Contrast that with charging higher prices on inventory sales to a higher tax foreign subsidiary corporation, Germany, involves more income to the U.S. and away from that foreign subsidiary corporation. You could also think about charging a royalty or management management fee to the high tax jurisdiction as well. You're just shifting income out via deductible payment. Now, your facts have to line up with that. You can't just start charging somebody a royalty, right? They have to use intellectual property. You formalize that via a license and have them compensate you via a royalty. Again, you can't just start charging management fees. There has to be a real management service offered to the foreign subsidiary that is going to be reasonable in pricing that as a deductible expense. And I put in the bubble, all transfer pricing positions are supported by contemporaneous documentation. So that's how you develop what is arm's length and what is the range. You do documentation on what third parties would do in a similar situation, and then apply that to your facts. That's your defense in setting up these transfer pricing arrangements. Applications of tax treaties. So this can limit or reduce foreign tax by of the U.S. company. So first of all, if you're doing business in branch form, maybe review the permanent establishment provisions. Am I a taxpayer? Maybe I can do something a little bit less and not be a taxpayer in Germany. I have to also think about German law on that side of that. Maybe I can just lower my threshold of activity so that I don't trigger the local tax presence. And we talked about lower withholding taxes. So one, make sure treaties are being applied where appropriate and people are reading them correctly and applying the lowest rate on those treaties. That's always a good housekeeping item. And so you can see these things. These projects are not 2-day projects. They're multi-month projects, so you have time to think about all these things. But these are big investments by companies usually, and they're getting tax advice, so you have time to craft all these things and try to get to the best answer you possibly can. So then, increasing the foreign tax credit limitation. So if I can increase the limitation, and that means I can potentially credit more foreign taxes. So very important if I'm working in a higher tax foreign country. So increase the gross foreign source income, right? That can, examples of that planning, what do we talk about? If I foreign title passage for the sale of purchased inventory. So if your fact pattern is the U.S. company is buying inventory and then reselling it to the foreign subsidiary in their location, then I can choose where I put that income by where title passes, right? Remember the rule for purchased inventory is title passage. So if before that transaction starts, you talk to the business people and the legal people and say, hey, I would really like to have foreign title passage and here's why. We can put that that gross income in this basket and that's going to boost up the limitation, lower our global tax burden. That may be something you can get as well, or at least try, right? And remember this, your foreign tax credit limitation is based on your net foreign source income. So expenses, if you're going to deal with the expense side of this, is trying to recharacterize expenses as being U.S. sourced. Some of that planning could be alternative apportionment basis for SG&A. So if you remember back in half A, we looked at SG&A expenses, and we looked at different apportionment keys, right? One was gross income, one was sales, and you can choose and craft your position around the apportionment key that makes best sense for your company, and maybe that can get you more income, more expenses sourced to U.S. sources and away from foreign source income, boosting up the multiplicand and the FTC limitation calculation, right? So again, you're just, I look at it as the international tax practitioners sitting back there mechanically pulling levers and turning dials, right? Again, there's no home runs. You're just doing lots of little things that you can do to try to make the overall answer as best you can. Another strategy to increase the FTC limitation is to blend low tax and high tax foreign source income within a separate FTC basket. Remember when we talked about the cross-crediting? You can't credit income across baskets, but within a basket, I can credit all day long. So if I'm in the branch basket, and my branch basket has low taxed income in it. No, say it has high tax income, so I got a branch in Germany, paying 30% tax, so I got excess credits in my branch basket FTC limitation. The next investment, if the business people are talking about doing business in Ireland, talk to them about doing it in branch form, right? Because then you can put that low tax branch income, offset your high tax branch income, and blend it down from the German rate down to something closer to 21%. Right? So that's a way of being proactive to blending your FTCs from high tax operations and low tax operations within those four baskets. Can't go across baskets, but you can go within baskets, right? What we just learned about last week, availing of U.S. export benefits. So if I'm doing export sales, export services, or licensing to foreign licensees, can I avail of the FDD-EI deduction? That's the new regime that goes forward January 1. And what does that do? That reduces my U.S. income tax imposed on such income streams from 21% to 14%. Right? So maybe the next investment, hey, have we thought about the United States for this investment? If the product is ultimately destined for foreign markets, maybe we can capture that income at 14% instead of 21%. 14% is pretty good on your global effective tax rate. And that would certainly make you popular with the current administration. Maybe you get some support via social media posts. But if you choose to make that investment in the United States, maybe you can get a lower tax burden on that. So make sure you're availing of the U.S. export benefits. Tax efficient supply chain management. We have a degree here in supply chain management. So global organizations are inherently complicated, right? Lots of intercompany activities going on in the way they're servicing the globe. And so moving goods and services from suppliers through the U.S. company's global operations and ultimately to its customers. From a tax perspective, some key aspects of the supply chain include the types and locations of those entities that are involved and the contractual arrangements amongst those entities. So if you're doing any supply chain planning or you're doing anything operational that's related to movements of goods or functions or services, you need to have the tax people at the table. Because when business is making some changes, that's when tax people can influence where and how we're making those changes. That doesn't mean that they win, but I've met most people that are operational, that are trying to do something for supply chain, and first of all, they might say, I already have a big group, I don't want another person in the room, and I don't need tax in there. But when you tell them, I might be able to make your savings even better, come on in, because they're going to count your tax savings against their overall project savings, right? Because they're trying to lessen expenses, increase revenue. One of the expenses is tax. If you can do something where they're going to do a center of excellence, well, where is that center of excellence going to be? What if they're thinking about, well, we're thinking about Germany and Ireland as our two alternatives. Great. I think we should do Ireland because I can get that tax rate at 12.5% instead of 30%. I think they would be very interested in that. So whenever you get a whiff of those types of initiatives going on within an organization, get tax people involved. If you are a tax person there, raise your hand and say, hey, can I participate? Because those are great ways to try to influence and increase the benefits of those projects. Now, transfer pricing plays a critical role. I can't arbitrarily shift income in the supply chain, right? Held to the arm's length standard. So I have to charge and price things as I would third parties. But what can be different here is transfer pricing relies on risk and responsibilities within the supply chain. So if I concentrate risk and responsibilities in a particular location, that's going to attract more profits to that location. So if business is moving people and centralizing things,
running things on a regional basis. They're restructuring Europe, and they're gonna centralize the leadership of Europe. You guys have all heard of Switzerland being a popular location to do so. Why? Switzerland is a nice place to live.